Guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Monday. It is February the 7th. And what I am going to do in this video is talk about compounding. Now, some of my most recent videos might have been a little bit elementary or basic if you're an old pro. And to this end, this particular video is probably going to be educational as well and not necessarily targeted at you. But, you know, I have a very large number of new investors in my sort of YouTube channel, in our investment community, and I need to be cognizant of the fact that not everybody is necessarily up to date with everything that we talk about and everything that we do. And what I'd like to make sure we do is give everyone an equal chance to generate some cash and grow their portfolios and build some generational wealth. So specifically what I'm going to do here is talk about compounding. I'm going to give you some examples of what I mean exactly, because I've mentioned this a few times before. And in the previous video that I made, I talked about a DRIP, which is a dividend reinvestment program. There were some interesting comments on that via email, LinkedIn, on the channel itself. And I thought, hey, you know what? Why don't you just take a few minutes and talk about compounding? Hey, I know that there are many of you who know all this stuff, right? So this video is probably not for you, but there are a lot of people who don't really understand the beauty of compounding, and that it's for you that this video is good information that I hope will help you to grow your portfolio in leaps and bounds and just make you super rich over the longer term, especially if you're a young person. You know, if you're 20, 25, 30 years old, and you've got 20, 30 years of investing ahead of you, you can build an enormous portfolio, an investment portfolio, just applying yourself diligently to making sure you do your homework, pick some really good stocks, reinvest those dividends, and just watch it grow over time. So take a look here, and I'll explain it and walk you through it. Let's take a look at the net worth of Warren Buffett. So when you look at Warren Buffett's age, he started at a very early age, which is a great idea. If you can get in early, now I just mentioned 20, 25, 30, 35 years old. If you can start there, don't worry about the fact that it feels as if you're making no ground and you're not really growing your investment. It'll come over time. You just got to do the right things, right? Look at the graph, the picture of Warren Buffett's wealth. By the time he was 52, he was only worth a few million. Now he's one of the richest people in the world. Now, you don't have to wait until you're 83, because you can start long before Warren Buffett really started making big money. If you start today, don't delay, start today. What is compounding? Compounding is simply adding interest on top of interest. In this particular video, I am going to describe how you add dividends on top of your original investment. And I'm going to show you how it works in just a second. What exactly is compounding in terms of a definition? You will generate earnings from both the initial principal amount, whatever you invest, and then the accrued earnings from the preceding compounding periods. So as you earn dividends on a quarterly, biannual basis, monthly basis, depending on how the issuer pays dividends, you will be generating earnings going forward on the initial principal amount that you invest, plus whatever dividends you reinvest in that particular issuer's stock. Eventually, thus, you will grow your wealth over time. How much time, Mr. Roxy? Well, not a lot of time, guys, not a lot of time. This is just simple math. An investment that grows at 15% per year will double every 5 years. Stick with me on this, because this is gold, right? If you invest, whether you can afford to invest $1,000, $10,000, $100,000 doesn't make any difference. It will double every 5 years if you can achieve 15%. How do we achieve 15%, Mr. Roxy? Well, I'm going to show you in a minute how you could possibly get to 15% per year on an annualized basis without taking ridiculous risks. So how does the math work? Because I said it's just pure, simple math. In year one, $1,000 becomes $1,150 because you add 15% in dividends, which is $150. And then in year two, the $1,150 becomes $1,322.50 because you add another $172.50. Why is it a larger amount? Because now you're growing at 15% per year on the new balance, which is 1,150, whereas your initial investment was only $1,000. Then at the end of year 2, you're at 1322, which will become 1520. 1520 will become 1750, and 1750 in year 5 will be $2,011.36, which means you would double your investment over 5 years if you can achieve a 15% annual compounded growth. Guys, I wish I had started when I was 20 or 25. I started a little later, much later even than Warren Buffett. And anyway, it's going okay. So I want you to at least take a portion of your portfolio and emulate what I've done in terms of arriving where I am today. So let's show some of these sort of details to you. 15% annually, Mr. Oxy, can you guarantee me that? Are you kidding me? Nobody can guarantee you that. Nobody. In fact, the last guy to guarantee anything at all that we all probably have heard about was Bernie Madoff. And he promised his investors 15% per year. That is not possible. I'm going to show you in a minute. It just isn't possible. But can you do 15% annually? Yeah, you have a good chance of doing that. What do dividends actually do if you have dividend paying stocks? Well, they offer a hedge against market volatility. We know the stock market is doing this, right? It's going up and down all the time. So at least if you're getting a quarterly dividend, you have some, even if it's a small hedge against that market volatility. But here's the beautiful thing. The reinvested dividends allow you to earn compounded returns. They also allow you to cost average, because even if the stock goes down, especially if the stock goes down, and then you get a dividend payment, you are actually buying more stock at a lower cost than what you perhaps might have opened your initial investment for. And remember, nobody can time the market. Stocks that pay high dividends for me are what I call my foundational investments. These are stocks that I basically just buy and hold. I own many of them. I'm going to show you a few in just a second. Always remember, if you want to trade stocks, and I'm not talking about day trading, I'm just talking about entering new positions, selling stocks, buying other stocks, whatever, hoping that you're going to strike it lucky somewhere along the line. It's kind of like playing the lottery, right? You only want to trade with money that you can afford to lose and invest the rest. So I have a portion of my portfolio, which is kind of my speculative portfolio, where I'll take a little bit greater risk. For instance, my uranium stocks would be an example of that. They're highly speculative. They don't pay dividends, and they go up and down like crazy, right? So they're in my speculative portfolio. But these stocks that I'm going to show you now are foundational investments for me. I literally just buy them and I hold them and I reinvest my dividends. What do they look like, Mr. Oxy? Well, here's one. AllianceBernstein. It's not a small company. It's a $4.6 billion market cap. Pays a dividend of about 7.5. In fact, it's not the 7.5. It's $3.58. And $3.58, which is an annual dividend yield on the stock price of $46, is currently yielding 7.67%. If AllianceBernstein's stock price were to drop to, say, $35.80, just to make it easy for me, that would be 10%. Then AllianceBernstein would be generating a 10% dividend for me. So that means I'm already 2/3 on the way to trying to make 15%. Then you can also look at the ex-dividend date. The ex-dividend date is the date where all holders on record of that particular date, will receive a dividend on the next dividend payout date. So the ex-dividend date, the last one for AllianceBernstein, was November the 5th, and they paid it out on November the 24th. The other thing that you can look at, as I'll show you these charts, and to make it easy, I basically just put a little green block around all the snapshots that I actually want you to look at. Look at the short interest, only 1%. Mega wealthy companies that pay out large dividends are generally not sold short in the marketplace, because most people who are short sellers don't expect these stocks to necessarily go down, because they are cash flush and they reward their investors very, very generously. So I spent a little bit of time, probably too much time, talking about AllianceBernstein. So we're going to look at the rest of them, just a few of them. Same snapshot, just different stocks. ICANN, our favorite uncle, Carl Icahn, his company's worth $15 billion. It pays nearly 15%, which means if the $54 stock price doesn't move at all for an entire year, I'm basically earning approximately 15%, because it pays $8 annually per share that you hold. His last dividend, ex-dividend date was 11. That's November 15th, and it paid out December 22nd. So 3 days before Christmas last year, I got a nice big fat dividend that I could reinvest in more stock of of ICANN Enterprises. And look at the short interest, 0.16. You got to be crazy to short ICANN. AGNC, an interesting one, because AGNC is a REIT. If you look at REITs, a REIT is a real estate investment trust. You can find several REITs. Maybe many of them are even better than AGNC. But I have a large position in AGNC. It's got a market cap of 7.5 billion, and it pays a dividend of about 10%. Now, right here at the bottom, I made a note saying, as a REIT, AGNC is required, this is by law, to pay 90% of taxable income back to its shareholders, which implies a consistent dividend payout. Neat, huh? You can find your own REIT. You don't have to buy AGNC like me. As I said, there are probably many better REITs that you can buy instead of buying AGNC. Enbridge pays me an ongoing dividend of $2.69 per share, which is about 6%. It's a mega company. So this is a Canadian super major in terms of Canadian energy companies with a market cap of $88 billion. Short interest, 0.92. You gotta be crazy to short Enbridge. Energy Transfer. This is one of my more recent additions to my portfolio. $31 billion company, pays a dividend of 70 cents per share. The stock is cheap at $9.93. That was the closing price today. Now look at this. The ex-dividend date was today. If you owned Energy Transfer today, which was Monday, February the 7th, then in a couple of weeks from now, on February the 18th, you will receive a dividend that will equal effectively 70 cents per year. Energy Transfer might increase this dividend. We'll have to see how they go. Short interest a little higher here, but still only 3%. Sibanye-Stillwater is also one of my new additions. $10 billion mining company out of South Africa, which is where I was born and raised. Dividend $1.65 is more than 10% right now. Sibanye pays dividends twice per year. Short interest just 1%. Last one, Petrobras, the Petróleo Brasileiro. I'm probably not saying that right, Brasileiro. Petrobras, a Brazilian energy company, same as Enbridge, $88 billion, mega super energy company in Brazil. Currently pays a dividend of $2 per share, which is almost 15%. Its last dividend was declared on December the 2nd and paid out on December 22nd. So guys, if you look at this on a chart, so coming back to my comment that I made just a few minutes ago saying no one can guarantee you 15%. If you average out the dividends that I just shared with you, it's sort of in the high single digits, 8, 9, almost 10%. How did these stocks do over the last year? Because that comes back to my comment about, can you do 15% per year? Can you achieve that, yes or no? Over the last 12 months, so this is a trailing 12-month TTM picture, AllianceBernstein is up 20%, Enbridge 23%, ICANN is down 11%, AGNC is down 12%, and Energy Transfer is up 46%, right? There's the picture on the right-hand side of the screen. If you average this out, you end up with a gain of around 20% or thereabouts, right? I mean, like, I'm not doing the math here, I'm just showing you a picture. These 5 stocks that I have on this particular chart here gave me a gain on my portfolio last year of about 20. And on average, collectively, they added another 10% in dividends on average, right? So these stocks here were up collectively approximately 30% for last year. I may go down this year, but then if I average it out over a 5-year period and I make 15%, I'm doubling my investment every 5 years. Now, guys, unlike you who are watching this video right now, if you are young, you have many multiples of 5 years ahead of you. I do not, but I'm showing you this now because I'm encouraging you to get in and get in early. Buy some of these good quality stocks. You just got to find them. You don't have to buy the stuff I buy. This is not a recommendation. It's not advice. I'm just showing you something, right? Find good quality issuers. Buy their stock when you are young. Reinvest those dividends. Invest the money that you can afford to invest and leave invested. And you are going to score big time as you get older. When you get to my age, you'll look more like Warren Buffett than like me. So guys, if you like the content, please subscribe. I look forward to your comments. And as usual, the comments are more entertaining than my videos. I'm glad you're still here. Thanks for watching. I'll see you soon. Bye-bye.